Illustration of arbitrage-free valuation. Suppose we're looking at a 3-year 5% coupon bond that's currently priced at 102. Now the probability of default is 2%, which therefore implies that the probability of survival is 98%. And at the same time, the loss given default is 60%. In other words, if the bond defaults, you can lose up to 60% of your total exposure, which would imply therefore that you would recover 40% of your exposure. And we're asked to calculate the arbitrage-free value, in other words, the estimate of fair price, using an expected set of spot rates. So the first step is to calculate the price at each nod, assuming that there is no default. And what's the logic here? Well, for me to know how much I can lose, I first need to see how much I would get if there was no default. And that's where this assumption comes in. So we introduce credit risk later. First we see how much exposure we have, and then we see how much of that we can lose. So tip, since the model is using benchmark, in other words, a risk-free set of spot rates, the resulting valuation at each nod would be for a risk-free bond. And this goes in line with what I said. So at this point, we're not even talking about any credit risk. Just pretend we're valuing a treasury bond. All right, now what we're going to do is we are going to assume that the risk-free prices at each nod are already given. So there it is, because it's very time-consuming, ladies and gentlemen. I don't think on the exam you'll be asked to calculate the price at each nod and at the end find out what the credit valuation allowance is. So we'll just take these as given. So here are the prices. And H and L just stands for high and low. So how did we get to this nod? We went one high. How did we get here? We went one low. And just very quickly, how did we get to this nod? One high, two high. That's how you get HH. How did we get to this one here? One H, one high, one low. There's one high, one low. Or alternatively, here's one low, one high. And then finally, LL, we got two lows in a row. So here are various scenarios. And like I said before, these prices will be given. And now when you make it to t equals 3, remember it's a 3-year bond. So when you make it to the maturity date, the bond will be worth 100. It's par value. Now the only other piece of information you'll notice that I've included in this framework are these little brackets here. And these are probabilities. So we saw this from a previous module. Not only do you need to identify what the value of the bond will be for each nod, but you also need to know the probability of arriving at that nod. So with a binomial model, there's a 50% probability for each outcome. So how did we get here? So 50% times 50% is 0.25. How did we get here? Well, there's this way. So 50-50, that's 25. But we could have also taken this route and that route, which is also 50 times 50, which is 25. So combined, you have two routes. Each one has a joint probability of 0.25. So 2 times 0.25 is 50%. And then finally here, there's a 25% probability we'll reach here because there's a 50% there and a 50% chance there. Okay, so ladies and gentlemen, we got all our ingredients. We know what the bond will be worth if it was risk-free at each nod. We know the probability of each nod. Let's see what's next. So step 2, we calculate the expected exposure for each year. So what we want to know here is how much total cash flow are we entitled to? Because that's the amount that we can lose if the issuer defaults. So the way to calculate expected exposure is we look at the probability weighted price. Is there any other cash flow you're entitled to? Yes, the coupon. It's a bond after all, right? Now, what would your expected exposure be for year 1? Because you have 2 prices for year 1. I need it down to 1 price. And this is why we use the probability weighted. So there's a 50% probability that the price will be 101 and a 50% probability that the price will be 104. That's exactly what I have there. Now, is there anything else you're expecting at t equals 1? Yes, a coupon of $5. So what's the total amount that you're exposed to at t equals 1? 107.50. So now you see why we needed this information for each node, i.e. the price at each node. Let me backtrack. The risk-free price at each node and the probability of that node. So you can calculate these, the amount of the expected exposure at each point in time. Now, how about for year 2? How about for year 2? What are you exposed to? Well, first tell me what your bond is worth. Well, at t equals 2, I have 3 possible bond prices. Well, can you just give me a probability weighted average? Sure. There's 25% of 109, 50% of 102, 25 of 105, and that's exactly what I have there. Is there anything else you're entitled to t equals 2 that you may lose if the issuer defaults? Yes, they owe me a coupon. So when you add all that up, you have a total exposure 107, and then finally at t equals 3, what are you exposed to? Well, that's the maturity. I expect the par, right? 100 plus the final coupon. So your total exposure at t equals 3 is 105. Okay, now these are the amounts if there is no default. So the next step is, how much can you lose if or given that the issuer defaults for each year? Well, we were told that the loss ratio, if there's a default, is 60%. So in year one, I'm entitled to total amount of 107.50, so I could lose 60% of that. That works out to 64.50. In year 2, I'm entitled to total amount of 107. Well, if they declare default at t equals 2, you could lose 60% of that, so you lose 64.20. And finally, if they declare default on their maturity date, you lose 60% of 105, so your loss would be $63. So that's how we start incorporating credit risk. Now, what's the other thing? First of all, if you look at this in its expanded form, it says loss given default. In other words, if there is default. So the next natural question is, well, what is the probability or likelihood of default? So do you see how there's a storyline, right? So you can't just say, oh, if they default in year 1, I'll lose 64.50. Because then the next question is, well, how likely is that? And that's exactly what we'll do in step 4. So what is the probability of default in year 1? Well, we were given a default probability of 2%. So there's a 2% probability that they'll default at t equals 1. Well, what's the probability that they'll default at t equals 2? But what does that imply? So if you're defaulting in year 2, what does that mean about year 1? That means you survived in year 1, which is a 98% probability. And then you default in year 2. So then you multiply these two probabilities together, you get 1.96% as the probability of defaulting by t equals 2. And then finally, what's the probability that you'll default at t equals 3? Well, what does that imply? It implies that in year 1 and year 2, we survived. So those are 98% probabilities. And then in year 3, if there's a 2% will default. So when you multiply all these probabilities together, you get 1.92%. So what do we got here? We've got potential amounts I can lose, potential probabilities of this event actually happening. So the next step is to find the expected loss, which combines the two. So we look at the loss and then we multiply it by its probability. So we get the probability weighted, or otherwise referred to as expected loss for each year. This is how we incorporate credit risk. Then step 6, that's when we calculate the credit valuation allowance. And so credit valuation allowance is the present value of these expected losses. So in step 5, what we're doing is we're really quantifying credit spread, or I should say credit risk, on an annual basis. So what CVA does is just says, all right, just tell me what all that is worth today. So that's why we find its present value. Now, because we're using the arbitrage-free valuation framework, we discount not using one discount rate, but we discount each cash flow timing by its unique discount rate. That's the whole point with spot. With spot rate says that the required return on a cash flow due in year 1 is different than the required return on a cash flow due in year 2. So assuming that the spot rates are given, we just discount, right? So here's the first year's loss or expected loss, discount at the 1 year spot rate, 1 period. This is the second year's expected loss is $1.26. The 2 year spot rate is 4%, but you discount it back 2 periods, right? And finally, the third year expected loss is 121, discounted at the 3 year spot rate, which is 5%, discounted back 3 periods. And then when you find the present value of all these expected losses, works out to $3.46. So this amount here captures credit risk. Therefore, step 7, to calculate the price of the corporate bond, we look at the price of the risk-free bond, and then we subtract the amount or the allowance for credit risk. So as we've calculated previously, and I just wanted to bring you back to original data. I just wanted you to see where the that 106 came from. So this was the risk-free prices which we assumed were given to us. So that's where it's coming from. Now I'm willing to pay $106 for this bond if it was risk-free, but because it's a corporate bond and it does have risk, I'm going to demand a discount because this thing is risky. So I'm only going to pay $102.54 for it. And ladies and gentlemen, you know, we got ingrained that in our heads. If we are looking at an investment and it's got a risk, we don't pay more for it. We pay less for it. And that's exactly what this is saying. So if you had 2 identical bonds and one is risk-free, but the other one is risky, I'll pay less for the risky one. Now this 102.54 is based on a model estimate because, I mean, look at all the assumptions that went in, ladies and gentlemen. I mean, we had to estimate probability of default. That's discretionary. We had to estimate the amount that we could lose if there was default. So this 102.54, even though it says, the model says P, that's really fair price. In other words, it's what we think or what we estimate to be fair price. But then what we have to do in step 8, we compare the actual price to our estimate of fair price. So we think this bond is worth 102.54. So if it's currently trading at 102, this actual price is slightly undervalued. Okay? It's because it's a little bit less than 102.54. So if the price is undervalued, remember there's an inverse relationship between price and yield, right? That would mean the yield and therefore the spread is higher versus fair value. And here's the connection. Here's the connection. Look how straightforward these frameworks are. Price is the present value future cash flows, right? And you could see the inverse relationship between price and yield. So if the price is slightly low, it's because the market is pricing in a slightly higher yield. Now, if the yield is higher, and of course the benchmark rate is not going to change, right? Benchmark rate has got nothing to do with what's happening with the credit risk of this corporate bond. So with a higher yield, if the yield is a little bit high, that would indicate that the spread on this bond is slightly higher than fair.